Hello everyone. Today I'll go over the last part of mechanics of options markets. Today I'm going to talk about the payoff and the profit chart for different positions and options. Mainly I'll start with an example covering call options. So in this example we have a long call position for an option with a strike price X, let's say, is equal to $50. The price of that call option is, let's say, $4. So we will see at different stock prices what are the payoffs or the profits from this position. Now, whenever you want to draw the graph of this position, so here you will have the stock price ST, and here you will have the profit or loss of the position in dollars. Now, you need to determine what happens for any price below or above X. So for example, for ST less than X. Now remember, in this case that the call option holder, so the long call will give the holder the right or the option to buy at X. So in this case, the payoff is the maximum of ST minus X and 0. So this is the payoff of the position. In this case, if the stock price is below X, ST minus X is going to be less than 0. In this case, the holder will choose not to exercise. So in this case, for any price ST less than X, the holder will choose not to exercise. The payoff is gonna be 0. When I compute the profit of the position, I need to include 0 the payoff minus, so it's the maximum of ST minus X and 0 minus the premium minus this $4. So this is equal to minus 4. So mainly for any price below X, I will have a loss, a constant loss of $4. Now, the second case, for ST greater than or equal to X. Now, whether I put the equality here or with ST greater than or equal to X, it's the same thing, because whenever ST is equal to X, I will be indifferent, because whether I exercise or not, the payoff is gonna be equal to 0. So now for the second case, I will take ST greater than X. So if ST is greater than X, in this case, I have the payoff is the maximum of ST minus X and 0. Because ST is greater than X, this value here is greater than 0. Therefore, the payoff is gonna be this positive difference, ST minus X. So at this point in time, there is gonna be exercise. Now, the profit once there's an exercise is equal to ST minus X minus C, the call premium. Now, I can determine the break-even point at which stock price I will break even, I will have a profit equal to 0. So that the payoff, so this is mainly the payoff from exercising the option, the payoff will exactly offset the paid premium or the price of the call option. So in order to determine this break-even point, I will set the profit equal to 0. So I will say I will have ST minus X minus C is equal to 0. In this case, the stock price is equal to X plus C. So this is, if you want, the general equilibrium or the general break-even point for a call option. The stock price is equal to X plus C. In my example, ST should be equal to 50 plus 4 equals to 54. So now I have this point here, let's say this is 54. So mainly at a price above 50, at or above 50, I can exercise. For a price between 50 and 54, what's happening is that I'm reducing my loss. Instead of losing $4, let's say I'm losing $2 if ST is equal to 52. Once I reach 54, I will have a payoff ST minus X of $4 that will offset the premium of $4. And at this point in time, I will have a break even. My profit is going to be equal to 0. For any price above 54, I will have a positive profit. And as you can see, because there are no limit on the upside potential of the stock, I can say that there's an unlimited profit potential. So here I have a limited loss. And in this case, my loss is limited to the premium that I've paid, to this minus $4, or in general, it's minus C. Once I get to the strike price, I will exercise whether I will end up with a profit or not. So mainly I will be either minimizing my loss or generating a positive profit once the price is above X. Once I get to this point here, which is in this example 54, and in general it's X plus C, I will have a positive profit. And as you can see, there's unlimited profit potential. Now, working with that same example, if I wanna check what's the profit for the party with the short position, I'm gonna use a different color. So in this case, the party with the short position will have exactly the opposite of the payoff or of the profit of the party with the long position. So here, when the price is below 50, below the strike price, the party with the long position will not exercise. This means that the party with the short position will be able to get the full $4, the premium. So there will be this maximum profit for the party with the short call, because in this case, the party with the short call can keep all of the $4. So this is here the case of the short call. Now, once we hit the strike price, once the stock price is at or above the strike price, the party with the long position will decide to exercise. So this is here the party with the long position. So at this point in time, the party with the short position will start losing part of the $4. As long as the price is below 54, the party with the short position will still end up with a profit. Once we reach 54, the cash outflow or the negative payoff, which is minus 4, will offset the premium collected by the short seller of $4, and there will be a break-even point. For any price above 54, there will be a net loss for the party with the short position. And as you can see, for the party with a short position, the maximum profit is limited. So there's a limited profit, which is the premium collected. However, there's an unlimited loss potential. So that's it regarding positions and calls, whether we have a short position or a long position. Now, it's important to know how to draw the graph, especially when we get to option strategies. And in this case, like in general, like whenever you have a strategy involving multiple options, you can start by drawing the graph of each and every position, and then you can try to combine them together. And whenever you are drawing the graph of any single position in options, you should always look into first the strike price, determine what will happen below that strike price and what will happen above that strike price, and after that you can determine the break-even point. Now I move to another example that relates to put options. So I will start with the long put. Let's say that X is equal to 100 and P is equal to $7. In this case, I will also take two cases into consideration. If ST is less than X, and then if ST is greater than X. Now, in this case, for the long put, when the stock price is below the strike price X, I can also include a special case where the stock price is at its lowest value. So when ST is equal to 0. So this is a special case under the first part, ST less than X. Now, for the party with the long position, the put gives you the right to sell at X. In this case, your payoff is gonna be the maximum of X minus ST and 0. So this is the payoff. So for ST less than X, X minus ST is gonna be greater than 0. So in this case, the party with the long position will choose to exercise, and the payoff is X minus ST. The profit is the payoff minus the premium. Now, if I go back to that special case here, if ST is equal to 0, so what will happen? What's my profit in this case? Profit is equal, X is 100 minus 0 minus 7. This is equal to $93. And this is mainly the maximum profit, because this is the lowest price that the stock can reach. It can never go below 0 due to the limited liability. So here, this is, if you want, my starting point at $93. So this is the profit or loss of the position, and here I have the stock price. So at a stock price of 0, I will have my maximum profit of $93. Now, as ST increases, is above 0, my profit is gonna go down until I reach 0, until I reach my break-even point. So after I determine my maximum profit, I'm gonna determine my break-even point. I will break even when my profit is equal to 0. This means when X minus ST minus P is equal to 0. This means I will break even when ST is equal to X minus P. This is the general break-even point for a put option. In this example, ST is equal to 100 minus 7 equal 93. And mainly this is the same as the maximum profit. So as you can see, the maximum profit is equal to the break-even point. Of course, this is the maximum profit when ST equals 0. And this is ST when the profit is equal to 0. So in this case, as the stock price is increasing, my profit is decreasing until I reach that break-even point of $93, where I have X minus P. Now, when ST is greater than X, when ST is greater than X, X minus ST is negative. Therefore, I will choose not to exercise my option, and the payoff in this case is gonna be 0. Here, let me keep going till I get to X. So here, this is X, this is 100. This is the strike price of the option. So between 93 and 100, I will start losing. When I get to $100, I will have my maximum loss. Because as you can see, for any price above X, I will choose not to exercise. And in this case, my profit is minus $7. I will be losing minus $7, whatever the stock price is above 100, whether it's 1,000, 900, 105. For any price above $100, my loss is limited to $7. So here I have a limited loss, which is limited to the value of the premium P, which is in this case $7. My profit with a put option can be high, it's $93 per share. However, it's still limited, not like with the case of a call option. Now, if I want to consider, so this was the long put. If I want to consider the short put, it's a mirror image. It's exactly the opposite. So here I will be starting with minus 9, excuse me. So here I'm starting at minus 93. And then here, this is the maximum loss, which is limited. And the maximum profit is the $100. And this is when the stock price is above 100. So those are mainly the graphs for the main positions and options for the call and for the put option, and whether I have a long position or a short position. We'll learn later on how to combine different positions and different options. So this is the short put. And here you have a summary. However, here in this case, you have a summary of the payoffs. And if you want to determine what is the option position in each case, the first one here, this is a long call. Now, definitely you don't have to memorize the graphs, but you can easily visualize the graph, and you can easily draw the graph from scratch. That position over here, the mirror image of the long position, this is a short call. This position here is the long put. And finally, this position here is the short put. Okay, so as we already know, like options as other derivatives, they have built-in leverage. So here in this example, we're gonna compare the performance of a long position in an option versus a long position on a stock. So in this case, we consider a stock with a price of $100. We are expecting the stock to appreciate in value. So in this case, we have $10,000 to invest, and we can either invest in the stock directly by buying each share at a price of $100, or through investing and buying call options with an expiry date of 6 months where the premium per share is $10, and where you have that the contract size is 100 shares. This means that each call option will cost me $1,000. However, each contract will allow me to buy 100 shares over that 6 months period. Now, the first strategy is to, and here we are considering 3 strategies. The first strategy is mainly a full investment in the stock. So mainly I have $10,000. The stock price is 100. I can buy 100 shares. The second strategy, strategy B, invest entirely in at the money call options. This means I'm buying call options with a strike price X equals $100. So in this case, I buy 1,000 call options, each selling for $10. So mainly I'm buying 10 contracts because each contract is covering 100 shares. So in total, I will have the right to buy 1,000 shares at a price of $100 each. So as you can see from the beginning, like here, the exposure is for the price of 100 shares. Here, the exposure, if the stock price appreciates, is for 1,000 shares. So you can see like this built-in leverage. So it's 10 times my exposure in strategy A. Finally, I have strategy C where I only buy one contract. This means I have the right to buy 100 shares for a price of $100 each. The price of the contract is $1,000, and in this case I will invest the remaining $9,000 in 6 months treasury bills. This means I will be earning the risk-free rate over this 6 months period. In this case, assuming that we are earning 3% interest, the bills is gonna be worth $9,270 at expiry. So $270 is mainly, this is the return on those treasury bills. So this is a guaranteed return. So whatever happens with the stock price, I will end up with this $270 on my investment and treasury bills. Now let's see the performance of each strategy. So mainly those are the strategies. In each case, this is a summary of the strategies. I'm investing in each case $10,000. In A, I'm investing the full $10,000 in stocks. In B, I'm investing only in options by buying 10 contracts. In C, I have what's called a leveraged equity position. So here I'm investing $9,000 in the risk-free asset and $1,000 in call options. So now this is the performance of those different positions for different prices. And as you can see, with the second strategy entails the highest level of risk, because if the stock price is below $100 or below, I will end up losing the $10,000. I will lose all of my investment. However, if the stock price appreciates in value, I will have a positive payoff. Now, of course, as long as the payoff is below the premium paid, which is $10,000, so in this case, I will need to get to $110 in order to break even. However, if the stock price increases by 20%, I will be able to realize a 100% return. Because in this case, I will have $20,000 as a payoff, minus the $10,000 paid to buy those call options. This means I will end up with $10,000 in profits. Now for the stock position, as long as the stock price is greater than 100, this means that I will end up with a profit. But like, let's say for an increase of 20%, so if the stocks increases by 20%, I will have this $12,000 as payoff. So now that payoff, that $12,000, it already includes the $10,000 that I've paid initially. So mainly that $12,000, this is the position value. So my profit when the stock price is 120, my profit is exactly $2,000, which is a return of 20% on my money. So when I invest all of my money in the stock, my return is mainly the stock return. Now, when I consider the last strategy, Portfolio C, which includes a long position in the call plus a long position in the treasury bills, here when I do not exercise, I will have 9,270 because this is the payoff from the position in the risk-free asset. My payoff from the call option is 0. At 105, I will have 9,270 from the risk-free asset, in addition to $500 on the call, because here I have only one contract. In this case, my payoff is 9,770. Now, as the price increases, my payoff will increase by $500. And then down here you have the percentage returns. So you see that for Portfolio B, I will lose all of my investment if the stock price is below 100. At 105, like even if the stock price increases by 50%, I will be losing 50% of my investment because I will be able only to recover $5,000 out of the initial investment of $10,000. At 110, I will break even. At 120, I will realize a 100% return. For Portfolio A, I will have exactly the return of the stock because I'm investing all of my money in the stock. Finally, for Portfolio C, as you can see, like for that one, there's less volatility. Because here, if I go, let's say, to 90 or 85 or 80, I will be losing with Portfolio A. In the case of 80, I will be losing minus 20%. However, for Portfolio C, my loss is limited to minus 7.3%. There is no way I will lose more than that because 90% of my investment is in the risk-free assets. So I will know for sure that I will have $9,270 in the future, whether I exercise the option if the stock price is below 100. And if I exercise it, this means I will first reduce my loss and then I will start generating a positive return. Here you can see an illustration over a graph. What will happen with those three positions? And here I'm going only till a price of $84 as the lowest price in this graph. But like here, mainly you can see that how there's more risk when I talk about the long call. So with the long call, I can move from a loss of minus 100% to a profit. If I reach 120 of 20%, it can, excuse me, this is 100% return, and it can be even beyond 100%. And here you can see the other two strategies. This is A, and this one here, this is C. And as you can see for C, there's a limited loss. And this is something we will learn later on in an upcoming chapter how to replicate or how to build a synthetic option, whether a call or a put option. So as you can see, portfolio C, where I'm investing part of my money in the call and part of my money mainly in the risk-free asset, the payoff here is similar to that of a call option. However, with the loss is limited, but it's much lower, and the upside potential is unlimited, but it's much lower relative to the long call. Okay, now for the last part, I will go over some types of options. Like mainly here, I'm gonna discuss warrants, I'm gonna discuss employee stock options, and finally convertible bonds, because those instruments, they have, if you want, a built-in option. First of all, the warrant, like few companies may issue those instruments, which are like options sold directly to the public, and they will allow the holders to exercise them and buy shares directly from the companies. So the case of the warrant is like a call option where the party with the short position, where the seller is the corporation. And in this case, it's not like the corporation is gonna, let's say, buy the shares from the market. It may be like to issue new shares based on these warrants. So in this case, the investor, the buyers of those warrants will will benefit if the stock price increases in the market and they are able to buy it from the corporation at a lower price. So let's say they are able to get it for a price of $100, and currently the stock price ST is equal, let's say, to 125. So they can buy it from the corporation at 100 and then sell it at the market for a price of $125. And warrants are mainly traded in the same way as stocks. Now, another type, employee stock options. So employee stock options, they are mainly like granted to top executives, like in a corporations, and mainly here in order to have an alignment between the interests of the owners of the company and the executives of the company. So in this case, the executives are going to be motivated to work in the best interest of their shareholders. Because if you remember, the goal of any corporation is to maximize shareholders' wealth. And maximizing shareholders' wealth is mainly through maximizing the share price, maximizing ST. And in this case, the employee stock options are mainly like call options. So the higher the stock price, the higher the profit on the call options. So in this case, the employee or the executives of the corporation may have an incentive to do whatever it takes in order to increase and maximize shareholders' wealth, because a large part of their compensation is related to the stock performance. And most of the time, each corporation can issue those options or grant those options to employees at different strike prices. Most of the time, they are issued at the money. And here we're not going in details like through the specifics of those stock options, because mainly once those employee stock options are issued, the executives cannot directly exercise them. Because if they can't directly exercise them, there may be like an incentive for those executives, let's say, to manipulate the financial statements or do anything that will push the stock price higher over the short term. However, let's say when they are granted that the expiry date is in 7 years. However, the employees cannot exercise them until they reach year 3. So those options, let's say, can be exercised over a 4 years period from year 3 till year 7. And as I said, this is to prevent the executives from manipulating their financial statements or doing anything just to make the stock price increase over the short term. So doing that, it means that the executives will have to take decisions that's gonna increase shareholders' wealth over the long term, that's gonna increase the stock price over the long term in order to benefit from those call options. So now when options are exercised, the company issues more shares and sell it to the option holder for the strike price. The final example is related to convertible bonds. So mainly convertible bonds are mainly similar to any bond. However, they have what's called as an embedded option, an embedded call option. So in this case, the owner of the bond or the bondholder, it's like the bondholder has a long position on a bond and at the same time a long position on a call option. So for example, let's say that a convertible bond was issued at par value. Let's say that initially the price of the bond was $1,000. The yield on that bond is equal to the coupon rate, equal, let's say, to 5%. This bond is a convertible bond. This means that each bond can be converted into, let's say, 20 shares. Let's say that currently the price per share is 0 when the bond is issued. S0 is equal to $30. So in this case, if you want to convert your bond into shares, it's like you are gonna only receive $600. The shares you're gonna receive are $600. The value of the shares that you will receive is less than the value of the bond. So in this case, you will simply decide not to exercise because the value of the bond is greater than the value of the 20 shares. Now let's say that 5 years later, ST is now, for example, 51. So now if you exercise, you will have 20 times 51, 1020. And assuming that over this period of time, interest rates were at or above 5%, this means that the bond value is $1,000 or below, the investor may decide to exercise. And mainly a convertible bond is an interesting case to analyze because the convertible bond is similar to bonds in a way and similar to equities in a way. Because once the stock price increases above, let's say 51, it's now 60, 62, the price of the bond will now follow the stock price. So the convertible bond at high stock prices will behave like a stock, and at low prices, at low stock prices where the stock price is, let's say, is below 50, it will behave like a regular bond.